Welcome to The Explainer. Today, we're taking complex financial research and turning it into clear, visual insights. We're actually diving into a pretty fascinating paper from the European Central Bank. It's all about the massive, totally hidden plumbing of our global financial system. I mean, we're talking about a world that operates entirely behind the scenes, yet it's literally the fabric holding our modern economy together.
So think about this for a second. Do you know where your financial assets are actually held? If you're assuming your stocks, bonds, or mutual funds are just sitting safely in a regular bank account or held directly by your broker, well, you're in for a huge surprise. The reality of where these assets live and the institutions that actually guard them is way more complex and, honestly, way more interesting than most of us realize.
To make sense of this trillion-dollar industry, here is our roadmap for today. Part 1. The Invisible Financial Vault. Part 2. Comparing Financial Giants. Part 3. The Rulebook Mismatch. And Part 4. Profitability Under Pressure.
All right, let's jump right into Part 1, the Invisible Financial Vault.
Let's unmask the main character, or maybe the square peg, in our regulatory story today, the custodian. Now, the absolute crucial thing to understand here is that a custodian doesn't operate anything like the retail bank on your corner. A traditional bank takes your deposit and creates commercial money, right? They grant long-term loans. But a custodian, they act strictly as an intermediary. They're basically a safekeeper of financial information. They ensure secure asset storage and act as a conduit to make sure incredibly complex, cross-border financial transactions settle smoothly. They are absolutely not in the business of creating credit.
And just to give you a sense of the sheer, honestly unimaginable scale we're talking about here, BNY Mellon, the largest global custodian in the world, holds a staggering 33 trillion euros in assets under custody. 33 trillion. To put that into perspective for you, that single institution holds assets roughly equivalent to the GDPs of the United States and China combined. It's just massive.
So what do they actually do with all that? Well, custodians act as the ultimate global back-office suppliers. Their clients are mostly other huge financial players, insurance companies, asset managers, central banks. And for these clients, custodians handle the complete physical and digital safekeeping of their assets. But it goes way beyond just storing things. They process corporate actions. So, for example, making sure a dividend payout reaches the exact right account across over 100 different international markets. They also provide multi-currency cash accounts to make borderless trading possible, and they offer independent net asset value assessments for investment funds. Basically, they are the gears making the entire global financial clock tick.
Okay, moving right along to Part 2, Comparing Financial Giants.
Now that we've got a handle on what they do, let's compare them to the traditional retail banks we all know. And this really highlights the core difference. A regular retail bank runs an asset-driven balance sheet. They run what's called a mismatched book, meaning they'll lend out money for a 30-year mortgage while funding that loan with short-term customer deposits. They're creating commercial credit. But a custodian, their balance sheet is entirely liability-driven. It's completely dictated by the deposits their clients just happen to leave with them to facilitate trading. And because those clients might need that cash at literally a moment's notice to settle a trade, the custodian has to maintain highly liquid, incredibly safe assets. Their whole world is focused on exact, real-time record-keeping, not risky long-term lending.
What's really fascinating here is how custodians sit in this awkward middle ground. They're caught between traditional banks and financial market infrastructures like central securities depositories, or CSDs. See, custodians actually have a banking license, exactly like a traditional bank. But their balance sheet and their revenue streams, those look exactly like a CSD. They generate their revenue strictly through fees and commissions for the services they provide, not from the net interest income of lending your money out. So they really are a true hybrid.
And because they aren't lending money out for decades-long projects, the types of risks they're exposed to are entirely different. Their credit risk is pretty much limited to short-term intraday overdrafts. We're talking about tiny, temporary windows of credit used simply to help immediate client transactions go through across different global time zones. Once the trading day settles, that risk basically just vanishes.
Which brings us to the real friction point today. Part 3, the Rulebook Mismatch.
This is where we hit that square peg in a round hole problem. Under European law, specifically the Capital Requirements Regulation, any institution that takes deposits is legally classified as a credit institution. So what happens? These highly specialized, fee-driven safekeepers get legally bound by the exact same strict prudential requirements as your local retail bank. Regulators are essentially treating a massive, hyper-liquid data vault as if it were a local mortgage lender.
The European Central Bank uses this one-size-fits-all methodology called the Supervisory Review and Evaluation Process, or SREP, to evaluate these institutions. This framework looks heavily at risks to capital and risks to liquidity. Now, don't get me wrong, this is a fantastic framework for keeping retail lenders in check, but applying it to fee-driven custodians, it subjects them to severe capital and liquidity rules designed for risky credit creators, totally ignoring the unique operational realities of the custody business.
The resulting regulatory friction is just huge. Applying traditional banking indicators to a custodian is, well, practically useless. Take bank runs, for example. Supervisors constantly worry about panic withdrawals. But for a custodian, reality flips completely upside down. During a financial crisis, panic's clients actually rush to custodians for safety. In fact, during the COVID-19 dash for cash in early 2020, deposits at State Street surged by 57% in just a single quarter. A custodian's real threats are not bank runs. Their nightmares are severe IT operational failures or a sudden bottleneck in intraday liquidity.
So how is this impacting the industry? Let's look at part 4, profitability under pressure.
This regulatory mismatch isn't just a paperwork headache. It has very real economic consequences, and custodians are feeling the squeeze right now. They operate in an oligopoly, but they still face brutal price-based competition because, let's face it, clients often view basic custody services as interchangeable. On top of that, to keep the global markets running without a single glitch, custodians have to absorb massive fixed IT infrastructure costs. And if that wasn't enough, layer on a monetary policy challenge, prolonged low and sometimes even negative interest rate environments.
To make matters worse, negative interest rates turn a custodian's core operating model completely upside down. Remember, their business model forces them to hold a massive pool of highly liquid, safe assets. But consider the yields from early 2020. European central bank deposits, German sovereign bonds, even deposits at CSDs. They were all yielding negative returns. So the very safety net regulators require them to hold ends up acting as a massive, continuous drain on their profitability.
You're probably wondering, what is their survival strategy here? How are these giants adopting? Well, first, they're deliberately trying to shrink their balance sheets. They're actually charging clients a premium for holding excess cash, literally passing those negative rates straight on. Second, they are ruthlessly cutting costs. We're talking extreme IT automation and offshoring a lot of their back office staff. And finally, they're fighting back by evolving. They're transforming from simple safekeepers into advanced data aggregators, even acquiring tech firms so they can sell premium analytics back to their clients, leveraging the trillions of dollars of data already flowing right through their pipes.
Ultimately, the authors of this ECB paper come to a pretty emphatic conclusion. Regulatory authorities absolutely have to stop using a one-size-fits-all approach. If we want a genuinely stable financial system, supervisors need to start evaluating these unique institutions based on the actual idiosyncratic operational and intraday risks they face, instead of grading them on a rubric designed for a traditional mortgage lender.
And that leaves us with a critical question to ponder as we wrap things up today. If regulators keep smashing the highly complex square peg of global custody into the round hole of traditional banking regulation, are we inadvertently setting the stage for an entirely unseen financial breakdown? Understanding the distinct mechanics of these invisible vaults isn't just some dry academic exercise. It is absolutely vital to the stability of our entire global economy. Thanks so much for joining me for this explainer, and I really hope this gives you a completely new perspective the next time you think about where your money actually lives.